You don't own a business. You actually own a high-stress job that will fire you the very second you get sick. I know. That's a hard pill to swallow, especially when you've spent the last 3 years building your brand from nothing. But let's look at your daily schedule, right? If you stopped answering emails, if you stopped taking sales calls, or if you decided to disappear for 3 months, would your bank account continue to grow? Or would the entire operation collapse? Most founders I meet are trapped in what I call the self-employed cage. You're proud of your title, but you're actually just an employee who works for the most demanding boss on the planet. Yourself. You have no benefits, no safety net, and your income is tied 1-to-1 with your personal output. This is a job business. It's fragile, it's exhausting, and it's mathematically impossible to scale because you only have 24 hours in a day. An asset business, however, is a different species entirely. You see, an asset is a system that produces cash flow regardless of your physical presence. It's the difference between being the baker who has to wake up at 4 a.m. every single morning and owning the bakery franchise that runs on standardized protocols and hired management. One is a liability dressed up as a dream. The other is a wealth-generating machine. Throughout this video, I'm going to show you exactly how to transition from the grind to the machine. I'm going to reveal the specific 5x multiplier that professional investors look for. A secret that most small business owners ignore until they try to sell their company and realize it's worth $0. If you want to stop working for your business and start having your business work for you, you need to understand the mechanics of scaling. Let's break down the trap before it breaks you. Let's get into the numbers that actually matter. Because look, most entrepreneurs believe their business is worth what they feel it's worth. In reality, and I mean this as a reality check, the market doesn't care about your feelings. It cares about your EBITDA. If you aren't familiar with the term, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. For the sake of our strategy today, I want you to think of it as your business's raw operating profit. This is the baseline for how investors and buyers measure the health of your machine. But here is the brutal truth. Two businesses can have the exact same EBITDA and be worth completely different amounts of money. Imagine you own a service-based business that nets $200,000 a year. On paper, you're doing great, right? But if you are the one closing every deal, managing every client, and making every high-level decision, you don't actually own a business. You own a high-paying job. To a sophisticated buyer, that $200,000 is a massive risk. If you leave, the profit leaves. Consequently, they will value your business at a 1x multiple. They'll pay you $200,000 for the whole thing and wish you good luck. You just spent years building a company, only to exit with 1 year's salary. Now, look at the alternative. Suppose I help you take that same $200,000 profit and wrap it in a system. You hired a capable manager. You've documented every process, and you've automated your lead generation. The business runs whether you wake up or not. Suddenly, that $200,000 is no longer owner-dependent income. It's a hands-off cash flow asset. In the world of wealth management, that shift in structure changes your multiple from a 1x to a 4x, 5x, or even a 6x. The math is simple, but it's life-changing. $200,000 times a 6x multiple is $1.2 million. By changing the delivery, not the profit, you just increased your net worth by $1 million. This is why the multiple is the only number that truly determines your wealth. You can work twice as hard to double your profit, Or you can work twice as smart to quintuple your multiple. One keeps you on the treadmill. The other prepares you for a massive exit. But even if you understand the math, there is a psychological wall that stops 90% of business owners from ever reaching that 6x valuation. It's a specific bottleneck that I see in almost every entrepreneur I consult. And if you don't break it now, your business will eventually hit a ceiling it can never recover from. You see, to turn your business into an actual asset, I implement a 3-step operational pivot designed to remove the most volatile variable in the equation: you. Now, step 1 is the 80-20 audit. I look at your calendar and your revenue streams with cold objectivity. I mean, looking for the real movers. In almost every business I analyze, 20% of the tasks are driving 80% of the growth, while the rest, it's just expensive noise. I take that critical 20% and I transform those tasks into rigid standard operating procedures, or SOPs. Because if a process only exists in your head, it has zero market value, right? By documenting these workflows, I ensure the business can breathe without your constant CPR. Step 2 is the founder extraction. This is where the discipline of wealth management meets the grit of scaling. I identify your biggest bottleneck, whether that's sales, product development, or operations, and I hire a tier 1 operator to replace you in that role. Look, this is the part where most entrepreneurs hesitate, because hiring top-tier talent usually means you might have to take a 15% pay cut in the short term. But I want you to look at the math, not the bank balance. You are trading a fraction of your current income to buy back your time, and more importantly, to prove to a future buyer that the company doesn't need you to survive. Finally, step 3 is margin optimization. I go through your profit and loss statement with a scalpel to identify and eliminate what I call zombie subscriptions. You know, those recurring software costs and services that serve no current purpose. Then I renegotiate vendor contracts to squeeze out every inefficiency. It sounds like small-scale accounting, but the leverage is massive. If I can boost your EBITDA margin by just 5% through these optimizations, I'm not just saving you a few $1,000s a month. On a standard 4x or 5x valuation, that 5% margin increase adds 6 figures to your final exit price. See, I am building a machine that prints money, not a job that demands your life. But even with a perfect operational structure, there is a hidden external force that can still wipe out your valuation before you even get to the closing table. There is one specific market ghost that haunts service-based and digital businesses alike. And if you don't know how to hedge against it, all this optimization won't matter when the economy shifts.
Look, I want you to visualize the wealth moat for a second. See, most entrepreneurs make the fatal mistake of keeping 100% of their net worth locked inside their own company. On paper, sure, you're a millionaire. But in reality, you are one bad market pivot away from total insolvency. I don't want you to just own a business. I want you to own a secondary engine that is completely decoupled from your daily operations. This is why I advocate for the 20% distribution rule. Every single month, you must automate a transfer of 20% of your net profits directly into diversified index funds, like VTI or VOO. Think about it. If your business clears $10,000 in profit this month, $2,000 disappears into the market before you even have a chance to reinvest it back into the business, right? You are systematically moving capital from a high-risk concentrated asset into a liquid diversified one. Now, let's simulate the long-term effect of this for a moment. If you're consistently hitting the market's historical average of roughly 10%, we can use the rule of 72 to project your trajectory. See, by dividing 72 by your rate of return, you find that your invested capital doubles every 7.2 years. But here is the part most people miss. Because you are contributing monthly, you create a compounding flywheel that eventually takes on a life of its own. Within a decade, the annual growth in dividends from this moat will likely outpace the salary you're currently drawing from your business.
This is the moment you transition from a business owner to a true wealth architect. You're no longer all in on one company, You are backed by the top 500 companies in the world. Even if your specific industry faces a total disruption, your lifestyle and your future are already secured. But, as I mentioned, even the strongest moat can be bypassed if the bridge is left open. While you're building this secondary engine, there's still that market ghost I warned you about. That external force that can slash your business valuation in half, regardless of how much you've saved. You need to know exactly how to hedge against it before you even think about an exit. I want you to take a step back and look at your company not as your job, but as the most important product you will ever build. Most entrepreneurs fall into the trap of becoming the most essential employee in their own building. But if you have to be there for the gears to turn, you don't own an asset. You own a high-stress, 80-hour-a-week job that happens to have your name on the door, you know? True wealth isn't measured by the size of your monthly distributions or the prestige of your title. I define wealth by a single brutal metric. How long could you walk away today before the whole thing collapses? If your answer is not even a week, then your business is a liability to your freedom. Real wealth is not about how much you make. It is about how much you can walk away from while the cash flow continues to grow. The transition from a business owner to a wealth architect happens the moment you stop working in the business and start working on it. You must build systems that make you redundant. Why? Because a business that requires your constant presence is a business that no one will ever buy. By removing yourself from the daily operations, you actually increase the valuation of the company because you've proven it can survive without the founder.
Here is your action plan for this week. I want you to perform a radical 80-20 audit. List every single task you performed over the last 7 days. I guarantee you that 20% of those tasks generated 80% of your actual revenue and growth. Your mission is to automate, delegate, or simply delete the other 80% that is currently tethering you to your desk. Scaling isn't about doing more. It's about becoming the person who does less of the wrong things. If you're ready to stop trading your time for a paycheck and start building a legacy that survives your absence, subscribe to Wealth Architects. I am here to help you design a life where your money works harder than you do. I will see you in the next one.